We are very pleased to be joined on the line now to discuss that OPEC Plus news, the group saying that it's going to bring oil back to the market as planned, but maybe not as hoped for from next month, by our second long-term business breakfast commentator with a new job. We spoke to Khadija Haque earlier. She's now head of the region, a very big region actually, for MasterCard in terms of being their chief economist. Amina Bakr is now head of OPEC and Middle East Insights at Kepler. Amina, good morning. It's nice to speak to you.
Good morning.
And congratulations, Mabruk, on the new role.
Thank you. No, it's really exciting.
It's great to still be able to speak to you and to speak to you on a morning when the market is digesting quite a lot, not just what it is seeing coming out from OPEC and friends, but also in terms of tariffs coming out of the US. Let's start with OPEC Plus, though, going to start unwinding the cuts that it's had in place for the last couple of years, despite delaying that start several times. Why now?
Good question, Brandy. And this is something that the market has been confused about. Ahead of the decision, a lot of traders and market observers were thinking that the group was going to push that pause button for the fourth time, and they didn't. They started the unwinding as planned. This plan was laid out very clearly last year, and the increments are going to be coming in starting from April. The reason they're starting now, Brandy, is because a lot of the group members have been sitting on a lot of spare capacity, have been very compliant, while others in the group, namely Pakistan, Iraq, Kazakhstan, haven't been abiding by their quotas 100%. So it's unfair for some members, like the UAE, for example, and Saudi Arabia, to have 100% compliance, while others are leaking supply into the market. So this balance things is out. And in addition to this, a new compensation strategy for those who have overproduced will be submitted to the OPEC Secretariat on the 17th of March.
Is there demand there for more oil?
This year demand, the consensus is around 1 million barrels a day. At Kepler, we have it slightly lower at 900,000. There is demand out there. However, there is a lot of supply too. And I'm talking about supply from outside of the OPEC region, whether it's from the US, Guyana, Brazil, and so on. So the market is facing this idea of oversupply. But currently, if you ask me what do fundamentals look like, I'll tell you things are pretty tight because the OPEC cuts have managed to tighten markets, and we see stocks drawing. Even stocks in the Chinese markets have been drawing at a high rate.
We've got those tariffs coming into force, though. What could that mean for the demand-supply picture?
Well, we have two things, Brandy, that Trump is introducing and confusing markets a lot. You have sanctions on one side, and then you have tariffs. It's kind of the yin and yang for the market, the pull and push. So what tariffs do potentially is slow down the economy, which means that less oil demand is going to be there. So therefore, we might end up with an even bigger oversupply. And then you have the threat of sanctions on some countries, and these sanctions possibly could take barrels off the market. So I see both threats out there in the market, creating some confusion and a lot of volatility.
The US president has called on OPEC, Saudi in particular, to lower prices by bringing oil back. Could those calls have had anything to do with this decision?
Not at all, Brandy. This was also, again, a lot of people drew that conclusion that the group is moving based on Trump's request. I want to tell you that this plan has been drawn out last year before Trump took office. This was always the plan. The market didn't believe it. This is another issue that the market has, maybe because OPEC delayed by 3 times and they were expecting another delay. But this was always in the works. And plus, prices are not at the level where Trump usually complains. When Trump complained, Brent was at $80. Now we're at 70. And he needs this kind of minimum to grow his shale production in the US. So this is the minimum required for that level.
Okay, so 2.2 million barrels to come back over the next 18 months. What impact could that have on prices?
Well, already we've seen the impact of prices. On the day of the announcement, we saw oil drop by 2%. Today, you're seeing, for yesterday, Brent dropped below 70 for the first time in a few years. And now prices of around 70. So it does have that dampened effect. Although, again, this is all based on sentiment and not real fundamentals, because these barrels didn't actually hit the market yet. So I would say sentiment will remain bearish in the near term.
The UAE is one of the countries, as you mentioned earlier, that will be able to increase production. What does that mean for us?
Well, it means a lot, and it's not just about the increase of production, Brandy. The UAE has been given an adjustment to its quota. It's 300,000 barrels, which will also be adjusted over an 18-month period. And this will give the UAE a bigger chance to use a lot of that spare capacity that it's been sitting on. So hopefully making ADNOC a more profitable company, and just generally spare capacity is quite costly to maintain. So reducing that burden from ADNOC.
Well, when we speak about the countries in the Gulf, Saudi, of course, making headlines this morning, also because of Aramco slashing its dividend. What does that mean for its biggest shareholder and its ability to pay for the projects that are on the drawing board?
Aramco is a giant by all means, and when it slashes its dividend, we're talking about two kinds of dividend. There is base dividend, and then there is the performance-based dividend. And what is being slashed is the performance-based dividend, but it's still giving a big chunk to its main shareholder, which is the government, but also the individuals. And even during the pandemic, Brenda, if you remember, that Aramco was one of the few companies that continued to pay dividends while other IOCs and so on were cutting dividends. So that's one area. But yes, cutting dividends by 30%, the performance-based dividend, might have an impact on government-based projects, anything linked to Vision 2030. Already, I mean, over the past year or so, we've seen a lot of projects in the press being delayed related to the line, NEOM, and so on. So maybe we're going to see a slowdown or a rehashing of some of these projects.
What does Saudi need in terms of pricing for government spending?
Well, they don't base it on one range. I mean, there are several break-evens. The budget usually works with three sets of break-evens: a low point, medium, and then high. But just generally, I would say maybe $75 to $80 Brent. This is the kind of ideal for the current situation. But they can adjust and adapt to lower levels.
Well, speaking of adjusting and adapting, OPEC Plus itself have said that the increase of barrels, the return of barrels to the market that we've been talking about this morning, could be paused or even reversed depending on market conditions. What kind, and I know OPEC doesn't go on prices, but what kind of market conditions are they talking about there?
No, for sure, they're going to keep an eye on the price. I mean, that's one factor. I mean, if it goes too low, that's also an issue. But I think they're also keeping a very close eye on what the impacts are in terms of everything that you said just there, Brandy, on the tariffs, sanctions, if there is a big oversupply. If we have a huge, for example, outage somewhere, they might even need to release more oil. So they are going to remain nimble, reactive, review this market on a monthly basis, and they want to send this message to the market that they will continue to be attentive.
Bakr, now head of OPEC and Middle East Insights at Kepler. Lovely to speak to you again. Thank you so much for your time this morning.